This is a review of the Chapter 13 practice exam. Whatever you're asked to complete here, you're going to also have to know how to complete on your actual exam. We're going to start out with accounting for merchandise inventory using the periodic method. And remember, under the periodic method, the merchandise inventory account is only correct periodically, which means it's really only correct at the end of the year. When we buy inventory, we're going to enter it into the purchases account, not the merchandise inventory account. And then we adjust merchandise inventory at the end of the year after we take a physical inventory. So let's get started. We're going to start out with a purchase of merchandise on account from Prestigious Jewelers for $33.20. So we're not going to put that in merchandise inventory. We're going to put it in purchases because it's the periodic inventory method. And then it was purchased on account, so that means we're going to credit accounts payable. And then we'll just enter the amount. On the 8th, we paid freight charge on the merchandise purchased of $3.50. Under the periodic inventory method, we take that directly to the freight in account. And it was paid, so that means it's going to come out of our cash. And that amount was $3.50. On the 12th, we sold merchandise on account to Diamonds Unlimited for $42.70. So we're just going to record the sale. And the sale was on account, so we did not receive cash. We received a promise to pay, so we're putting that in accounts receivable, and then we're going to credit the sales account. On the 15th, we received a credit memo from Prestigious Jewelers for merchandise returned. Okay, we returned this merchandise that we purchased back to Prestigious Jewelers. So we're going to have a purchase return. So to enter that, we're going to decrease our accounts payable. We originally owed a credit of $33.20, and now we're going to reduce that amount by $6.70. And then we're going to credit purchase returns and allowance. In the last entry, we have issued a credit memo to Diamonds Unlimited for merchandise returned. So this is going to be a sales return. And that is from this sale here. So we are going to enter sales returns and allowances as a debit for $8.60. And now we will credit our accounts receivable. We were expecting to receive $42.70, but since the customer returned $860 worth of merchandise, we're going to reduce the amount that we're going to collect from them by $860. And next we'll go to accounting for merchandise inventory using perpetual inventory. Now with the perpetual inventory method, we are using the merchandise inventory account actively. That means when we purchase inventory, it goes into the merchandise inventory account, not the purchases account. And then when we sell inventory, it comes out of the merchandise inventory account. In other words, we're keeping up with the inventory in the merchandise inventory account. Okay, let's get started. We're going to purchase merchandise on account from City Galleria for $3,100. So instead of purchases, I'm debiting merchandise inventory and accounts payable for $3,100. if we pay freight on the merchandise purchased, the freight becomes a part of the cost of the inventory. So instead of recording that separately in the freight in account, we're going to put it in the merchandise inventory and add it to the cost of the merchandise we purchased. Okay, and we paid it, so it is coming out of the cash account. On 13, we sold merchandise inventory on account to Amber Specialties for $3,200. That's what the customer is promising to pay. That was the price of our inventory, and the cost that we paid for the inventory is $2,400. So we've got to do two things with the sale. We have to record the sale, and then we have to move the merchandise out of the merchandise inventory account into cost of goods sold. Okay, so on the 13th we sold merchandise, so we will debit accounts receivable and credit sales, and the retail price was $3,200 that we charged our customer. Now we need to move the cost of the inventory out of merchandise inventory because we do not have that anymore. We sold it, and it is going to be a part of the cost of goods sold. So with merchandise, with the perpetual method, we don't have to do the long calculation for cost of goods sold like we do under the periodic method, because our cost of goods sold account is already calculated for us. On the 18th, we received a credit memo from City Galleria for merchandise returned. Okay, we sent some of our merchandise back. So since we returned that, we're going to credit merchandise inventory for the amount of the return. And then we're going to debit accounts payable to reduce the amount that we owe to that vendor, because we originally recorded the accounts payables $3,100, then we returned $680 worth, so we have to reduce our accounts payable. On the 22nd, we issued a credit memo to Amber Specialties for merchandise returned. So with our sale here, our customer returned $500 in merchandise that we sold to them. That is the retail amount. However, we need to take this merchandise back into our inventory that they returned at the cost, and the cost was $280. All right, so the first thing we're going to do is record the sales return and allowance for the $500. And we're going to reduce the accounts receivable for that customer. And now we're going to put the merchandise inventory back in at the cost. So since they returned it to us, we're going to add it back to our inventory and then take it out of our cost of goods sold. In the next problem, we're going to account for inventory using first in, first out, last in, first out, the weighted average method, and then the lower of cost or market method. All right, here is a list of all the goods we had available to sell for the whole year from January to December. We started with a beginning inventory of 1120 in units and made purchases, and we made our last purchase on December 3rd. We purchased 500 units. And notice the price changed every time we made a purchase. One important thing to always look for in these problems is the units of inventory on December 31st. This is our ending inventory. And we know that we have 1,000 units. We just need to assign the correct cost to those 1,000 units. So that's what we'll start to do. First off, we're going to start with calculating the cost of ending inventory. And we're going to start with first in, first out. That just means that the first inventory we purchased is the first that we sold. So we have sold everything except the last 1,000 units. The question is, how much are those 1,000 units costing? All right, so everything, let's see, 4,470 have been sold. 1,000 of these units is left in ending inventory. So we're going to start at the bottom to count our ending inventory because all the others have been sold. So we know we have 500 that cost $14.05, so that total is 7,025. And if we add 400 to that, that'll give us 900. So 400 units at $14 is 5,600. Now of this fifth purchase, 720 got sold, and we only needed 100 of those in the ending inventory to make our 1,000. So 500, 400, and 1,000 of these at $12 will be $1,200. 100 times 12 is 1,200. So if I add those together, 1,200, the 5,600 here, and the 7,025 from the last purchase, our cost of ending inventory under the FIFO method is $13,825. I want to show you that calculation, so I have completed it on a spreadsheet. So we have the ending inventory here where we've listed the last 1,000 units, the 500, the 400, and the 100 that was still left in ending inventory. And we totaled all those at their price, 100 at $1,200, 400 at $14, and 500 at $14.05. Will give us $13,825. Now over here is our cost of goods sold. This is the other 4,470 units that got sold. There was a total of 5,470. We still have 1,000, so we sold 4,470. And if we multiply out the cost of all those, we get $43,849 as our cost of goods sold. So let's put that back here. That was $43,849. And there's really an easier way I can get this figure. If I know that my ending inventory is $13,825, I can subtract it from the $57,674 and come up with the $43,849. When I add these two figures together, the cost of goods sold and the ending inventory, it should equal the goods available for sale of $57,674. Now let's do the LIFO method, the last in, first out. And it's kind of the opposite of first in, first out. With first in, first out, the first items in are the first items sold. With last in, first out, the last items that we purchased are the first sold. So in other words, we're selling all our new inventory and assuming that we're leaving our old inventory on the shelf. Therefore, the 1,000 units of inventory on hand under LIFO is going to be the first 1,000 from our beginning inventory, our oldest inventory. The 4,470 that go in the cost of goods sold will be the last 4,470, starting with the seventh purchase here. So let's look at that over here on our spreadsheet. Now remember, we had 1,000 units remaining in ending inventory. We're going to have to take those from our oldest inventory, the beginning inventory here. And their price was $8.10. So the total for the ending inventory is $8,100. Now we had $1,120 in beginning inventory, and if we have 1,000 in ending, then 120 got sold, and all the other inventory was also sold. So if we multiply across and add all the costs down, our cost of goods sold is $49,574. And then our ending inventory was $8,100. So let's go back over to the problem, and we'll enter our $8,100. And if we didn't want to go through all the calculations to calculate the cost of goods sold, we could just subtract the $8,100 from the $57,674, and we would have $49,574. Now keep in mind, if your ending inventory is incorrect, then when you subtract it from your total cost, then your cost of goods sold will always be incorrect. So double check the cost of your ending inventory if you're going to use that method to figure out your cost of goods sold. The next method is the weighted average inventory method. And this is probably the easiest method because you're just getting an average price for every unit of inventory. And to do that, you just take the total cost of your inventory and divide it by the total units, and you will get an average cost per unit. Now it's telling us to round calculations to 2 decimal places. So I've done the calculation over here. I've taken the total cost of the inventory of $57,674 and divided it by the total units in inventory, the 5,470. And I came up with 10.54369929. Now remember, we were told to round to 2 decimal places. So 2 decimal places to the right of the decimal is 54, and since following the 4 is a 3, it's below 5, we will not round this figure up. So the rounded cost per unit is $10.54. So we need to find the cost of 1,000 units. So to do that, just take 1,000 and multiply it by $10.54, and we'll get $10,540 for our ending inventory. Then for the cost of goods sold, we took the number of units sold, which was 4,470, and if you're not sure how to get that number, if we had a total of 5,470 units and we still have 1,000 that we didn't sell, that means we sold the difference. We sold 4,470 units. And if we apply the $10.54 per unit price, then we will get $47,113.80. Now we're going to follow the instructions here, and it says round calculations to 2 decimal places. So we got $10,540 for the cost of ending inventory, and then we got $47,113.80 for our weighted average total. Just checking those figures. Now, if you take the $10,540 and subtract it from the total cost under weighted average, you're going to be off 20 cents because of the rounding. But I have tried to go into the exams and give students points for any rounding errors that might have occurred in CNOW, so no worries. Now we will move on to the lower of cost or market. lower of cost or market is really much easier than it sounds. What we're going to do is compare the market price with whatever cost here. So for example, we have FIFO lower of cost or market. Well, we already have our FIFO cost up here. And remember, we're always dealing with ending inventory, not cost of goods sold. We're trying to value our ending inventory. So the cost under FIFO of ending inventory is $13,825. Well, the market price is $13 a unit, and remember we have 1,000 units in ending inventory, so that's 13,000. I'm going to choose the lower of these two figures. So the lower is 13,000. So that means that even though I'm carrying my inventory at 13,825 on my books, it's really, the fair market value is much lower than that. It's 13,000. So I'm going to write down my inventory. And to do that, I'm just going to say loss on write down of inventory, and then credit merchandise inventory by 825, because that's the difference in our cost and market. All right, for the weighted average lower of cost or market, I'm doing the same thing. Weighted average cost is $10,540. The market price is $13,000. I'm just going to choose the lower of the two, which would be the $10,540. I'm already recording my inventory at $10,540 on my books, so I don't have to do a journal entry for that one. So I'll just put no entry required there. Okay. So I've got the X's now turned into check marks. So don't be intimidated by the lower of cost or market problems. Now we're going to estimate our ending inventory using the gross profit method. And to complete the gross profit method, you have to know the following formula. And that formula is beginning inventory plus purchases equals goods available for sale less the cost of goods sold will give you the estimated ending inventory. Now, every number that you need for this formula is going to be provided to you, except for one where we have to do a little math, but it's easy math. And so when you prepare for your exam, make sure you have this formula written out on a sheet of paper somewhere so that you can just plug in the numbers. It says that a fire completely destroyed all the inventory of Glisson Lumberyard on October 5th. Fortunately, the accounting records were not destroyed in the fire. The following information is provided by Glisson for the time period. So what we're going to do is try to figure out the inventory that we had on hand at the time of the fire. So we're just going to plug the numbers in that we're given. Our beginning inventory is $90,000. The purchases were $408,000, and that will give us goods available for sale of $498,000. The number that we need to calculate is cost of goods sold, and we're given enough information in the problem to calculate it. We're given the net sales of $725,000 and then the gross profit percentage. That just means that 45% of these sales is our profit. The remainder of the sales is our cost. So you can calculate this figure two ways. I'm going to take 45% of the $725,000. All right, and that will give us $326,250. I'm just going to type that in over here somewhere. $326,250. This is our profit. To get the cost, we're going to subtract this figure from our sales. So if I subtract 326,250 from 725,000, we'll get cost of goods sold of 398,750. And when we subtract that figure from the goods available for sale, we get our estimated ending inventory of 99,250. Now, I take a little shortcut when I'm calculating the cost of goods sold. Since I know that the profit is 45%, then I know that the cost is 55%. If this is 100% of our sales, 45% of those is profit, 55% is our cost. So I would just take 55% of the 725,000 and I come up with the same number, 398,750. So whichever way you can remember it better. But after we subtract that, our estimated ending inventory is 99,250. So we'll go back over and enter that as our answer. In the last problem, we're going to estimate ending inventory using the retail method. And we're going to use the same exact formula that we used in the gross profit method, except this time we're adding an additional column. We've got a cost column and then also a retail column. If we have the figures we need at retail, we should be able to use those figures and figure out our ending inventory at cost. So I'm going to use these figures and I'm going to plug them right into the formula that we used for the gross profit method. And I've got those calculations on a spreadsheet. So notice that I've entered the formula first. Beginning inventory plus purchases gives us goods available for sale. And then I'm going to subtract out cost of goods sold. Well, it says net sales here because cost of goods sold at retail is the net sales. So we're going to subtract out those net sales, which is the cost of goods sold at retail, to get our ending inventory at retail. And then we're going to use that information to calculate the ending inventory at cost. So I've copied down the cost figures and copied down the retail figures. So I've added the two together and I have goods available for sale at cost and goods available for sale at retail. So what we need to figure out now is what percentage of this retail figure is our cost. So if I take the 219.30 and divide it by the 312.9, then our cost is 70% of retail. And we can use this figure now to figure out our estimated ending inventory at cost. So if we subtract out the cost of goods sold at retail, or our net sales, over under the retail column, our estimated ending inventory at retail is 51,000. Now, we know that the cost of the ending inventory is going to be 70% of this retail figure. So I'm just going to do the math, 70% times 51,000. So my estimated ending inventory at cost is 35,700. Now, on your exam and in this problem, you're going to have to also calculate your cost of goods sold. So that's really easy. You just subtract your goods available for sale and the estimated ending inventory at cost, and you will have your cost of goods sold. So we'll now take these figures and move them over to our problem. And as you work on these problems on your exam, just go ahead and write out the formula and write out the columns so that all you need to do is just insert your figures. And you can use this example, have the example next to it, so you can refer to that on your notes. So we'll go back and enter the ending inventory at 35.7, and the cost of goods sold was 183,300 maybe, can't remember, 183,330. Okay, and let's check those to make sure they're right.